So let's go to Randy here. We're getting to that time of the corner again. That's earnings season. Last earnings season brought stocks to all-time highs. That's despite higher for longer rates becoming a reality here, but there might be a reason to be a little more cautious this time around. Our next guest, Randy, you see him there on screen. He believes that there's a few yellow caution flags starting to flutter. Randy Frederick, who's the founder of RandyFrederickMedia.com, here to tell us more. So Randy, what are the main flags, if there are some yellow or some red flags that investors should be wary of going into this earnings season?
Hi, Brian. Not red yet, but I do see some yellow flags. So a couple of things that I've noticed is that, the equity put call ratios, which involve a lot of retail activity. And unfortunately, I hate to say it, but retail traders have a tendency to be wrong a lot, have been really hitting those levels of what I call extremes. And when they do that, they tend to be contrarian indicators. I don't think we're there yet. Right now, I think we're due for about a 2, 3, maybe 4% pullback here right about this moment. But it's amazing, and we talk about this all the time, history doesn't always repeat itself, but it often rhymes. This particular market we're in right now is rhyming very, very closely with the 2013 market. And at about mid-May of 2013, we had almost a 6% pullback. And it looks like we're setting up for something similar to that. Again, we have the markets at record level highs. We had a 10% gain in just the first quarter in the S&P. So that's a very strong move for a very short period of time. And people are just getting a little bit too comfortable with this bull market. It's time for some profit taking, not selling big positions, but just taking a little bit of profit off the table and putting on a few hedges.
Randy, I want to direct everybody's attention to the Wi-Fi Interactive, and I'll just describe what I'm seeing in case you can't see it. But this is the S&P 500. I'm putting on a chart that goes back to the 1980s. You mentioned 2013. I think this is a really interesting comparison. This was the year where the S&P 500 finally broke out of what was a 20-year, 2-decade trading range. Some call it a secular bear market. What reminds you about 2013, and then what can we expect if this is the case?
Yeah, well, if you overlay the two stock charts on top of each other and you scale the y-axis similarly in terms of percentages, obviously you can't use the same numbers because we're at a higher level, but if you scale it in terms of percentages, the trajectory is very, very similar. And again, we're approaching that proverbial sell in May and go away period, which people talk about it every year. The truth is, if you look at the month of May and you go just 2 weeks before and 2 weeks after, we've had a pullback in May 22 of the last 23 years. Sometimes it's only been 1% or 2%. Sometimes it's been more like 4, 5, 6%.
Or a flash crash.
But within a couple of weeks on either side, it's happened virtually every year. And again, this trajectory looks very, very similar to the 2013, which, as I said, had about, I think it was a 5.8% in the latter part of May.
What is the main catalyst, do you think, that companies are going to try and lean into this earnings season, Randy?
Well, I mean, we've had record high earnings, right? Just this last quarter, we're about 2 weeks away from the next earnings season. And, at some point, things have to cool off. They have to settle down. We look at things in terms of percentages, but as you get higher and higher, whether that's in a stock chart, whether that's in earnings, whether that's in comparisons of quarter over quarter revenues or earnings, either one, you ultimately have to hit larger numbers to maintain a consistent percentage trajectory. So things simply just cool off because that's how mathematics work. The other challenge we have, and we saw this with the numbers we got yesterday on the ISM manufacturing, we went into an expansion phase for the first time in a very long time in manufacturing.
Yes.
Realizing that manufacturing only represents about 12% of all the companies out there, but it tends to be a leader of the services sector. And so there's no real concern about a slowdown there. What it does do, and the prices paid component, if you look at that, shows that prices and inflation are still a problem. So there was almost 0% chance that we were going to get a rate cut in May. And now the percentage for the month of June has fallen below that typical threshold. If you go back 8 years for every rate hike and every rate cut, unless there was a 65% probability, it didn't happen. Now we're below that level for June. So we're already looking out past June before we can even hope for a potential rate cut.
Yeah, what if the market has it wrong? What if the Fed has it wrong and they get caught on the back foot here? In other words, I'm talking about a reacceleration of the economy with inflation as, I guess, a headwind. What does that look like? Because that would be kind of the no landing scenario that seems to be perennially priced out of the market, but here it is. We keep seeing evidence that the economy is a little bit stronger than we're used to. How does this play out in the market?
Well, I wouldn't see that as the Fed having gotten it wrong. I would say the Fed would have gotten it wrong if they'd already started cutting rates, which they have not done. The Fed's been so patient that it's frustrated a lot of people waiting for that rate cut. I think if we see a reacceleration of or a continued maintaining of the current inflation levels or even an increase in inflation, I would say the Fed has gotten it right by being very patient and not cutting rates. So, in fact, if anything, they could be forced into tightening more, which I don't think will happen at these current levels. But that means, honestly, I know it's not the consensus perspective. We could go this entire calendar year without any rate cuts at all, and the economy continue to chug along and doing just fine, and corporate sector is doing well also.
I know that you were a market strategist for quite some time, Randy. Put your market strategist hat on here. What's your top pick amid perhaps what we're laying out here and some of the caution flags that investors should be keeping an eye out for?
So a couple of things. Obviously, on days like today, when we get pullbacks, and I was expecting this, look at my commentary I put out last week, Thursday, I thought we would have a pullback that would start at the beginning of the quarter. Again, that's one of those patterns that repeats itself almost every quarter. Right as the quarter begins, the market will change directions. We were in a solid up phase, and now we'll get a little bit of a pullback. If you're in a down phase, oftentimes you get a move the other direction. So right at the moment today, and this week, we've got weakness in some of the cyclical sectors, as you pointed out just a few moments ago. This is an opportunity if you've been wanting to add some exposure in there to pick up some things when they're a little bit cheaper. Likewise, if you're a little too defensive, you're going to see, or if your holdings in defensive sectors, like you mentioned, staples, healthcare, utilities, are going to move up a little bit. If you're an options trader, and I often recommend people do this, even if you're not sophisticated, just use things like covered calls. When the markets, when your sectors are up, sell some covered calls to bring in some income. When you get a dip like right now, you can buy some of those back a little cheaper. I think longer term for this year, a cyclical perspective still makes a lot of sense, but you've got to be willing to make small adjustments when you get opportunities like we have. And I see dips like we're in right this moment as an opportunity.
Randy Frederick, who is the founder of RandyFrederickMedia.com. Randy, thanks so much for taking the time here this morning, kicking off the trading session with us.